The labor market is a ghost of its former self, and the Fed is flying blind into a recession that has already been triggered. While official headlines paint a rosy picture, over 800,000 jobs simply didn't exist, and the Sahm Rule is flashing a bright red warning.
Danielle DiMartino Booth, former advisor to the Dallas Federal Reserve, joins our lineup today to expose the data the politicians are spinning. We have used advanced AI to distill her expert warnings along with insights from James of Trade Brigade and Jeff Snyder into just a few minutes of high-impact intelligence.
Stop wasting hours watching full-length broadcasts. We've done the heavy lifting to give you the alpha immediately. Stay tuned to discover why world peace might be a market trap and how a hidden jet fuel shortage could ground the global economy sooner than you think. Today, we are looking at a masterclass in Fed watching from Danielle DiMartino Booth, the CEO of QI Research and a former advisor to the Dallas Federal Reserve.
Danielle's big takeaway is that the labor market is cooling much faster than the official headlines suggest, and the Fed might be behind the curve.
Wait, if she worked for the Fed, does that mean she knows the secret handshake for interest rate cuts?
Maybe not the handshake, but she definitely knows how to read the data before the politicians spin it.
She's focusing on the Sahm Rule, which is a key recession indicator that just got triggered.
The Sahm Rule? Is that like a 3-second rule for dropped floor food, but for the economy?
Not exactly. It's about the unemployment rate, and Danielle says it's flashing a bright red warning sign right now.
Exactly. We are looking at a major shift in how the Fed needs to handle the rest of the year.
Danielle DiMartino Booth argues the alpha here is that the labor market isn't nearly as strong as the Bureau of Labor Statistics says.
Right? They just revised the numbers down by 818,000 jobs. That is a massive chunk of the workforce that basically didn't exist.
Hold on. How do you lose 800,000 people? Did they just forget to count them?
It's about how they estimate business births and deaths. Danielle says their model is broken in a slowing economy.
So while the Fed was waiting for the cool down, it was already happening behind the scenes.
So, we've been looking at a ghost labor market this whole time.
Danielle points out that the Sahm Rule has been triggered because the 3-month average of unemployment hit 0.53% above its low.
Historically, once that threshold is crossed, we are already in a recession. There are no false positives.
Wait, 0.53%? That sounds tiny. Why is everyone panicking?
Because it shows a trend. Once unemployment starts rolling uphill, it usually doesn't stop until there's a real crash.
And Danielle's point is that the Fed is late to the party. They should have cut rates months ago.
So it's like realizing you're out of gas while you're already stuck on the highway.
There's also this huge divide. Danielle notes that high-end consumers are still spending because of the wealth effect from stocks and housing.
Wealth effect? You mean rich people feel rich so they buy more fancy watches?
Exactly. But the bottom 60% of earners are tapped out. Credit card delinquencies are spiking.
Danielle highlights that the K and K-shaped is getting wider. One side is soaring, the other is sinking.
So the stock market is essentially lying to us about how the average person is doing.
That is exactly what Danielle's data is suggesting. The aggregate numbers hide the pain.
Look at the sectors Danielle is worried about. Manufacturing and housing are both showing serious weakness.
The ISM Manufacturing Index has been in contraction territory for most of the last year and a half.
Contraction? Does that mean we're making fewer things, or just making them more expensive?
It means the wheels are slowing down. New orders are dropping, which is a leading indicator for layoffs.
And Danielle says housing is frozen because mortgage rates are too high for buyers, but sellers don't want to move.
So everything is just stuck. Great.
So what's the move? Danielle DiMartino Booth predicts a rate cut in September, possibly as high as 50 basis points.
Market expectations are leaning toward 25, but if the next jobs report is weak, they might have to go big.
50 basis points? Is that enough to save the laptop I can't afford?
It's more about stopping the bleeding in the labor market. A cut makes it cheaper for businesses to borrow and keep staff.
But Danielle warns that the first cut is often too little too late when a recession has already begun.
So the Fed is basically trying to put out a forest fire with a garden hose.
Danielle's darker prediction is that unemployment won't stop at 4.3%. She sees it heading toward 5%.
That would mean millions more people out of work, which crushes consumer spending and hits corporate earnings.
5% unemployment. That sounds like a lot of people losing their health insurance and Netflix accounts.
It is, and when that happens, the Fed will be forced to cut rates aggressively, which could devalue the dollar.
So we go from worrying about inflation to worrying about having a job.
I think I prefer the overpriced coffee problem over the no-job problem.
Danielle suggests watching the weekly continuing claims numbers. If they keep trending up, the recession is confirmed.
It's the best real-time indicator we have. Forget the monthly headlines, watch the weekly trend.
So if I see that number go up on Thursday mornings, I should probably tighten my belt.
Exactly, it's the smoke before the fire.
In this environment, Danielle is favoring liquidity. Don't get trapped in illiquid private equity or risky small caps.
Liquid assets, like cash in my mattress?
More like Treasury bills or high-quality money market funds. Things you can sell instantly if the market is tanking.
Following Danielle's logic, the soft landing narrative is a myth. Prepare for a bumpy ride.
Bumpy ride. Got it. I'll keep my hands and feet inside the vehicle at all times.
The market is absolutely exploding this morning. James from Trade Brigade is tracking a massive gap up in the S&P 500 and the Nasdaq thanks to a 2-week ceasefire peace deal.
It is a huge move. James points out that geopolitical relief is the primary driver here, but he is warning that we have to see if these levels actually hold after the bell.
Wait, a ceasefire? So my portfolio is green because of world peace for 14 days?
Pretty much. But James is looking for specific price action to confirm if this is a real breakout or just a trap.
Exactly. While the ceasefire is the lead, James' analysis shows a major risk for the Nasdaq if we hit a specific resistance point, which we will break down in just a second. According to James, the big question today is whether we see a gap and go or a gap and crap scenario.
He is watching the ES futures very closely around the 6,058 to 6,060 range. If that holds, the bulls stay in control.
Hold on. Gap and crap? Is that a technical term? It sounds like my Sunday morning.
It just means the market gaps up on news and then immediately sells off. James says if we break below 6,058, the trap is set.
James's data suggests that if we do not hold that floor, we could see a complete reversal of this morning's gains. James is eyeing the 21,500 level on the Nasdaq futures as a major psychological and technical target.
Right? But he notes that we are pushing into a heavy supply zone. There are a lot of sellers waiting just above where we are currently trading.
So even with the peace deal, big tech might hit a wall at 21,500.
That is what the charts are telling James. Momentum is strong, but chasing at these levels could be dangerous if the volume does not follow through.
He also highlighted that tech stocks like Nvidia are gapping into resistance, making the risk-to-reward ratio a bit tricky for new longs. We cannot ignore Tesla. James' analysis shows it gapping up and targeting that major $400 level.
Tesla is on a tear. James mentions it is gapping right over previous resistance, which could turn into a massive launch pad if it stays above 390.
$400? My cousin sold his Tesla shares at $200. He's going to be sick.
James suggests that as long as the broader market doesn't crap the gap, Tesla has a clear path to retest those psychological highs.
The key is the first 15 minutes of trading. James always looks for that opening range to set the tone.
The peace deal news has completely crushed the VIX. James notes it is trading down near the 13 level.
A low VIX usually means complacency. James warns that when everyone stops worrying, that is usually when a surprise move catches the market off guard.
Wait, so a low VIX is actually bad? I thought less volatility was a good thing for my nerves.
For your nerves, maybe. But James looks at it as a sign that the protection is cheap, which can lead to rapid moves if news changes.
Exactly. He's keeping a close eye on the bond market too, because Treasury yields aren't necessarily following the same peace narrative.
James predicts that if the ES holds above 6,060 after the open, we are looking at a straight shot to retest all-time highs.
It's a bold call, but the momentum from this peace deal is powerful. James believes the market wants to price in a quiet holiday period.
All-time highs. So Santa Claus is coming early this year?
Only if the bulls can defend that floor. James is adamant that 6,060 is the line in the sand. On the flip side, James is also preparing for a sell the news event. He thinks the initial spike could be met with profit-taking by noon.
His reasoning is that a 2-week ceasefire is temporary. Traders might take the money and run before the next headline hits.
So buy the rumor, sell the ceasefire, got it.
Essentially, James's outlook suggests that if we lose the opening candle low, the afternoon could be very red. James's main takeaway for today is to stay patient. He recommends watching the first 15 minutes of the regular session.
Right? Do not jump in blindly. James says the high and low of that opening range will dictate the direction for the rest of the day.
15 minutes. I can wait that long. Maybe I'll actually make some coffee while the pros fight it out.
Good plan. James also suggests keeping an eye on the dollar index as it is reacting sharply to the news.
Finally, James suggests sticking to the names with the most liquid volume, specifically Tesla and Nvidia.
They are the leaders of this gap. James notes that if they start to fade, the whole market is likely to follow.
So if Tesla crashes the party, we all go home?
Exactly. James' strategy is to follow the leaders, but keep a very tight stop loss at those key technical levels. Jeff Snyder's latest analysis is a total gut punch. He says jet fuel is running out and the airline industry is on the verge of a collapse that markets are completely ignoring.
Exactly. And Jeff argues that this isn't just about high prices. It's a structural shortage in the Eurodollar system that's choking off the physical supply of fuel.
Wait, Running out? Like planes are just going to stop flying because the tanks are empty?
Not exactly empty, but Jeff explains that inventories are at such extreme lows that any minor shock could ground entire fleets.
And while everyone is focused on tech stocks, Jeff says the real story is in the kerosene spreads, which we'll break down in a second.
The core of Jeff Snyder's thesis is that jet fuel inventories have plummeted to 30-year lows, creating a massive pricing bottleneck.
Right? And Jeff points out that refineries are prioritizing diesel over jet fuel because the margins are better, leaving the airline industry out in the cold.
30-year lows. That goes back to the early 90s. Why aren't we just making more?
Because, as Jeff highlights, we've lost significant refining capacity globally, and you can't just flip a switch to bring a mothballed refinery back online.
So we're essentially flying on a prayer and a very thin margin of safety. Jeff Snyder notes that the U.S. alone has lost 1.2 million barrels per day of refining capacity since 2020.
And Jeff's data shows that this isn't a temporary dip. It's a permanent shift as older plants are converted to biofuels or simply shut down.
1.2 million barrels? That sounds like a lot of missed vacations.
It is. It means the supply chain for jet fuel is incredibly brittle. Jeff argues that even if oil prices drop, the cost to turn that oil into jet fuel will stay sky high.
So the raw material is there, but the kitchen is closed. Jeff Snyder often talks about the Eurodollar system, and here he connects it to fuel. A shortage of global dollars makes it harder to finance energy shipments.
Exactly. Jeff explains that when banks pull back on credit, the liquidity needed to move fuel across the ocean vanishes.
Hold on, so it's not just that the fuel isn't there, but we can't afford the credit card to buy it.
Essentially, yes. Jeff's point is that financial friction is turning into physical scarcity.
It's an invisible wall that Jeff believes is the real driver behind these shortages. Jeff highlights that airlines are passing these costs directly to us. Ticket prices have surged by 25% in some regions.
And Jeff warns this leads to demand destruction. People eventually just stop booking flights when a trip to visit family costs a month's salary.
25%? No wonder my flight to Florida was $500 for a middle seat.
And Jeff says that's the trap. As demand falls, airlines cut schedules, which makes the remaining seats even more expensive.
It's a death spiral for the industry that Jeff thinks we are just beginning to see. What's Jeff's endgame here? He predicts we'll see multiple regional airlines file for bankruptcy within the next 12 months.
His reasoning is that smaller carriers can't hedge fuel costs as effectively as the giants, making them the first to go under when spreads spike.
So we're looking at fewer choices and even higher prices. That's a grim forecast.
Jeff sees it as a necessary but painful consolidation. The industry simply can't support the current number of planes with the fuel available.
Jeff Snyder also looks at the broader picture, suggesting the drop in the transportation index points to a 70% chance of a global recession.
Right, because if goods and people can't move efficiently, the economy grinds to a halt. Jeff calls this the canary in the coal mine.
70%? That's not a maybe, that's a probably.
Jeff's data suggests that every time energy and transport costs have spiked like this, a downturn followed shortly after. Jeff Snyder recommends watching the crack spread, the difference between the price of crude oil and the finished jet fuel.
If that spread keeps widening, it means the refinery bottleneck is getting worse, regardless of what the headline oil price is doing.
So if oil is cheap but the spread is high, my ticket is still going to be expensive.
Exactly. Jeff says that's the number that actually matters for your wallet and airline stocks.
Lastly, Jeff says to keep an eye on airline capacity announcements. If they start cutting routes, the crisis is hitting home.
It's the ultimate indicator of whether Jeff's prediction of a collapse is playing out in real time.
I guess I'll start looking for some nice road trip destinations instead.
Given Jeff Snyder's track record on these macro shifts, that might be a very smart move. Today, we are dissecting the technical analysis of Chris Vermeulen, who says gold and silver are sitting in a massive bull flag pattern that could lead to a 30 to 50% move.
Chris points out that while the market seems boring right now, this sideways movement is actually the flag part of a very bullish trend. And
wait, a bull flag? Is that like a red flag? Should I be worried or excited?
Excited, hopefully. It means the price moved up sharply and is now just resting before the next leg higher.
But Chris also mentions that gold miners are lagging behind the physical metal, which we'll get into shortly. According to Chris Vermeulen, gold is essentially stuck between $2,300 and $2,450 an ounce.
Exactly. He describes it as a coiled spring. The longer it stays in this range, the more explosive the breakout will be.
Wait, so boring is actually good? I thought we wanted to see numbers going up every day.
In technical terms, boring is consolidation. It builds a floor so the price doesn't just crash back down.
And Chris notes that once it breaks that upper level, we could see a very fast run to new all-time highs.
Okay, so I'll just keep watching the 2,450 mark like a hawk.
Michelle McElroy asked Chris about silver, and his take is that it's still playing catch-up to gold's performance.
Right, silver is the high beta play. When gold moves 5%, silver might move 10 or 15%.
Wait, so silver is just gold on caffeine? Why would I buy silver instead of gold then?
More risk, but potentially way more reward if the bull market really takes off.
Chris emphasizes that silver needs to clear the $30 mark decisively to confirm the trend.
$30. Got it. I'm writing that one down.
A key point Chris made is that the gold miners represented by the GDX haven't been keeping pace with the metal itself.
That's usually a warning sign, isn't it? If the companies pulling the gold out of the ground aren't making money, something's off.
Hold on. If gold is expensive, why aren't the miners rich? Are they just bad at their jobs?
High energy costs and labor inflation are eating their margins. Chris suggests waiting for the miners to show strength before diving in.
So physical gold over mining stocks for now.
Makes sense. Keep the actual gold, leave the shovels for later.
Chris also warned Michelle that the general stock market, the S&P 500, looks like it's topping out.
He's seeing signs of exhaustion. If the stock market corrects 10 to 20%, it might actually push more investors into gold.
Wait, so if my 401k goes down, my gold might go up? Is that how this works?
That's the safe haven play. Chris thinks we're approaching a major rotation.
But he also warns that in a massive crash, everything sells off at first, even gold.
Great, so no matter what, I'm stressed.
Looking at the charts, Chris Vermeulen's analysis suggests gold could hit $2,700 by the end of the year.
That's a pretty significant jump from where we are now. It's based on that bull flag breakout we mentioned.
2,700. That sounds like a lot. What has to happen for that to work?
Mainly, we need to see the dollar weaken and the Fed signal that they are definitely done with interest rate hikes.
If those stars align, Chris sees clear skies ahead for the yellow metal.
I'm checking my weather app for gold stars right now.
On the darker side, Chris predicts a potential 20% pullback in the broader equity markets.
He's watching the technical indicators showing that buyers are losing steam. This would be a massive reality check for tech stocks.
20%? That's not a pullback, that's a cliff.
It's a healthy correction in a long-term bull market, but it'll feel like a cliff while it's happening.
Chris believes this volatility is what will finally trigger the big move in precious metals.
So buy gold, hide under the bed for the stocks. Got it.
The main takeaway from Chris Vermeulen: watch that $2,450 level on gold like your life depends on it.
Exactly. Don't chase the price now, wait for the confirmation. If it breaks above that with high volume, that's your buy signal.
So, patience is a virtue or whatever. I was hoping for something faster.
In trading, being early is the same as being wrong. Wait for the flag to break.
Also, Chris suggests keeping an eye on the US dollar index, the DXY.
If the dollar stays strong, it's a headwind for gold. If the dollar starts to slide, gold is going to fly.
Wait, so when the dollar is weak, gold is strong? I can never remember which way that goes.
Think of it as a seesaw. Dollar down, gold up. That's the Chris Vermeulen playbook for the next 6 months.
Got it, seesaw. Dollar down, gold up. I'm ready.
We're dissecting Ken McElroy's latest warning. The middle class is being systematically priced out of the American dream.
Ken is pointing to a massive shift where homeownership is no longer a rite of passage, but a luxury reserved for the top tier.
Wait, so the white picket fence is officially dead for normal people?
According to Ken, it's on life support. High rates and big money are suffocating the average buyer.
And while the housing market looks like a dead end now, Ken reveals a specific build-to-rent trap that might be the final nail in the coffin, which we'll break down in a few minutes. Ken McElroy highlights the math that's killing the market: interest rates hitting 7%.
Think about it. That move from 3 to 7% essentially doubled the monthly payment for the exact same house.
Double? So a $2,000 mortgage is now $4,000.
Exactly. Most middle-class budgets can't absorb a 100% increase in their housing costs.
Ken calls this the affordability wall, and it's higher than it's ever been. One of Ken's biggest concerns is the Wall Street landlord phenomenon.
Ken notes that institutions are gobbling up 20 to 30% of the entry-level homes, often with all-cash offers.
How am I supposed to outbid a billion-dollar hedge fund?
You can't. They don't care about the inspection or the school district. They just want the yield.
So the starter home is being replaced by the corporate rental property, in Ken's view.
That's honestly depressing. We're competing against robots and algorithms now.
Ken also talks about the inventory freeze. Why would anyone sell right now?
Exactly. If you have a 3% mortgage, moving to a new house means trading that for a 7% rate. It's a massive financial downgrade.
So people are basically golden handcuffed to their current houses.
Ken's analysis says yes. That keeps supply at record lows, which keeps prices artificially high.
It's a stalemate. No one wants to sell, and no one can afford to buy.
Ken points out that while house prices have skyrocketed, median wages have only crawled up.
The gap is wider now than it was in the 2008 bubble.
Wait, so it's actually worse than the Great Recession?
In terms of affordability? Absolutely. Ken's data shows the average family is spending more of their income on shelter than ever before.
I guess ramen for dinner is the new middle-class standard then.
Ken predicts the massive rise of build-to-rent, entire neighborhoods built specifically for corporate ownership.
Instead of selling individual homes, developers are selling entire streets to institutional investors before they're even finished.
So even new construction isn't for us. It's just a pre-packaged rental empire.
That's Ken's vision of the future. The renter nation isn't a theory, it's a business model being built right now.
It completely bypasses the individual buyer. What's the end game for the middle class, in Ken's view?
He expects homeownership rates to drop significantly over the next decade as the barriers to entry become insurmountable.
Is there any silver lining here? Or are we just doomed to pay rent forever?
Ken suggests the shift will force a total rethink of wealth building. Real estate might not be the primary vehicle for the middle class anymore.
It's a structural change, not just a temporary market dip. Ken's advice? Stop watching the headlines and start watching the 10-year Treasury yield.
Right, because mortgage rates follow the 10-year yield like a shadow. If that yield stays high, your mortgage isn't getting cheaper.
The 10-year Treasury. Okay, adding that to my watch list.
It's the only data point that truly matters for your borrowing power.
Ken suggests looking into creative financing like subject-to deals to bypass high interest rates.
Essentially, you're taking over someone's existing low-rate mortgage instead of getting a new one.
Is that even legal? Sounds like a loophole.
It's perfectly legal if done right. Ken believes this is how savvy buyers will survive this renter nation transition.
So, I need to become a real estate ninja to own a house. Challenge accepted.
Today we are analyzing Andy Schectman's perspective on why the precious metals market is currently at a historic crossroads.
Andy is the president of Miles Franklin and has spent over 30 years tracking global money flows and central bank behavior.
Wait, 30 years? So he's seen every bubble and crash since the 90s?
Exactly. And he tells Adam Taggart that what we're seeing now, specifically the drainage of physical metal from the West, is unprecedented. The real bombshell? Andy notes that central banks bought 1,037 tons of gold last year, the highest level in history.
And while they're buying, the paper price in the West is being suppressed. It's a massive disconnect.
Wait, so the big banks are buying at record levels, while the news says gold is boring? That feels like a trap.
It's the ultimate do what they do, not what they say moment. But stick around, because the silver data is even more explosive. Andy Schectman's core thesis is that the world is moving toward a multipolar financial system.
Right? He points to the BRICS nations and over 40 other countries that are lining up to join a new economic bloc.
40 countries. That's a huge chunk of the global population just deciding they're done with the dollar.
That's the plan. They want a commodity-backed currency to bypass the U.S. financial system entirely.
And that commodity, according to Andy's analysis, is primarily gold.
So basically, gold is becoming the world's new membership card.
Let's talk silver. Andy highlights a staggering annual deficit of roughly 200 million ounces.
The industrial demand is relentless. We're talking solar panels, EVs, and now high-end electronics for AI.
200 million ounces short? Can't we just dig more out of the ground?
It's not that easy. Most silver is a byproduct of mining copper or zinc. You can't just flip a switch to get more.
So we have exploding tech demand and stagnant mining supply. That's a textbook squeeze.
So my smartphone is basically eating the world's silver supply.
Andy notes that the COMEX registered silver inventories, the stuff actually available for delivery, have plummeted.
It's down 50% in just the last 2 years. The physical metal is leaving the Western exchanges.
50%? Where is it all going? Is someone hoarding it in a basement?
Mostly to the east. India and China are importing massive amounts of physical bullion while the West trades paper contracts.
It's a drain on the system that can't continue forever without a price break.
So the vault is literally becoming half empty.
Andy explains to Adam that the price you see on the news is the paper price, which doesn't reflect physical reality.
Exactly. If you want a physical silver coin, you're paying a huge premium over that spot price.
Wait, so the price on my screen is a lie?
It's not a lie. It's just for a digital contract. If you want the actual metal in your hand, you have to pay the real-world price.
Andy argues that eventually the physical market will break the paper market and force a massive revaluation.
It's like looking at a picture of a burger versus actually buying one.
What's the endgame? Andy predicts gold will continue hitting record highs as the dollar's dominance fades.
He sees it as a mathematical certainty. As more countries move to gold-backed settlements, demand will skyrocket.
So gold is basically the ultimate insurance policy against the dollar losing its cool.
That's exactly how Andy frames it. It's the only asset that isn't someone else's liability.
It's the one thing that central banks can't print into oblivion.
Hard to print a metal that comes from a supernova. I get it.
And silver. Andy thinks it could actually outperform gold in terms of percentage gains.
It's because it has a dual role. It's a monetary metal like gold, but it's also an essential industrial commodity that's running out.
So it's like a stock that's also a currency.
Essentially, when the industrial users realize the supply is gone, they'll pay whatever it takes to keep their factories running.
Andy suggests that silver is the most undervalued asset on the planet right now because of this.
Maybe I should check the cushions for some silver quarters.
If you're following Andy's lead, the primary takeaway is to prioritize physical possession of metals.
Right, paper ETFs might not be there for you if the system faces a real liquidity crisis.
So if you can't hold it, you don't own it.
That is the mantra. If the COMEX vaults go to zero, your paper certificate might just be a piece of paper. Andy also suggests keeping a close eye on inventory levels at the COMEX and LBMA.
Those levels are the canary in the coal mine. If they continue to drop, a price explosion is likely.
So we're watching the drainage of the vaults to know when to move.
Exactly. It's the most honest data point we have in a manipulated market.
And when the vaults are empty, the game changes for everyone.
I'm keeping my eye on the vault door then.
To kick things off, Danielle DiMartino Booth argues the labor market is an illusion. Official numbers hide significant job losses.
Absolutely. She points out that beneath the surface, there are over 800,000 jobs that just don't exist anymore.
Wait, so we're being fed a rosy picture while the ground reality is pretty grim.
Exactly. And this sets the stage for some serious economic implications. Next up, Jeff Snyder has a stark message. The economy is heading towards a recession due to credit tightening.
He emphasizes that as liquidity dries up, we're bound to feel the pinch in the coming months.
So you're saying the Fed's current policies could backfire?
That's the fear. Tightening too much may create the very recession they're trying to avoid. Then we have Ken McElroy, who introduces the idea of a renter nation.
He cites the decline in home affordability as a driving force behind this shift, making renting the preferred option.
So less home ownership means more renters. What does that do to the market?
It suggests a seismic shift in how we view housing investments, one to watch closely. Despite their different angles, all three agree serious challenges are on the horizon.
Right. Danielle highlights the misleading statistics, Jeff warns about recession risks, and Ken talks about housing crises.
So, it's safe to say we need to buckle up for a bumpy ride.
Exactly. No matter where you look, it's all about navigating these uncertainties. Interestingly, Danielle and Jeff also share similar views on the data. They both suggest current metrics are deceiving.
Yes, Danielle focuses on misleading job figures, while Jeff points to financial indicators like credit flows.
So it's kind of like a mirage. Looks great, but the reality is much harsher.
Exactly. The disconnect between the data and reality could have serious implications. Now let's talk disagreements. Danielle is optimistic, predicting recovery in the labor market soon.
In contrast, Jeff argues we'll face a drawn-out recession period.
So one's saying 6 months, while the other says we're looking at years.
Exactly. Their timelines couldn't be more different. Then there's the housing debate. Ken emphasizes immediate changes in rental demand.
Meanwhile, Danielle and Jeff concentrate on overarching economic factors.
So Ken's looking at the now, while the others are looking at future economic patterns.
That's spot on. Two sides of the same coin. If you enjoyed the insightful contrasts shared today, give us a like and subscribe for more expert analysis.
You'll always get the quick hits on finance without the fluff.
Seriously, they just packed so much into a few minutes. I'm definitely subscribing.
Thanks for tuning in. Keep an eye out for our next video where we'll bring you more crucial insights.